Now let's continue with the determination of consolidated net income after modification for the effects of unrealized intercompany profit. Consolidated net income was calculated in Chapter 4 as the parent company's income from its independent operations that has been realized in transactions with third parties, plus or minus subsidiary income or loss that has been realized in transactions with third parties, plus or minus adjustments for the period relating to the depreciation, amortization, or impairment of differences between fair value implied and book values. So the determination of consolidated net income for 20x5, we begin with the net income of the parent from its own operations. Then we add realized gain on sale of equipment for a downstream sales through depreciation. A perfect company's realized net income from separate operations. Now remember that in downstream sale, the seller is the parent, and whatever realized profit should be added to its net income from separate operations. And as well as we add the net income from the operations of the subsidiary, and we add the realized gain on sale of equipment, considering that there is an upstream sales through depreciation. So take note that whatever realized income from downstream sales should be added to the separate net income of the parent, and whatever realized gain on sale with regards to upstream sales or the seller being the subsidiary should also be added to the separate net income of the subsidiaries. So we now compute for the separate net income of the subsidiary from its own operations. Then we add both the parent and the subsidiaries net income. We get the total and deduct the amortization of allocated excess, whatever excess, considering that we have under or over valuation. So we have now the consolidated net income for 20x5 and deduct the share of the non-controlling interest. So the difference is the share of the controlling interest for the year. Or we have the alternative determination of the consolidated net income, and as well as the net income share of the parent. So we have now the alternative solution. Now, for the non-controlling interest in net income, the non-controlling interest now is computed as the net income of Sun Company from its own operations, as we have computed above 75,000 plus the realized profit from the upstream sale. Now remember that this is the subsidiary's income. So we now get the realized gain on sale of equipment from upstream sale, and we now get the total and deduct whatever amortization of allocated excess. Then 20% of it belongs to the non-controlling interest. So meaning the non-controlling interest plus the interest of the controlling we now get the total consolidated net income. So we have now the consolidated retained earnings to be computed, retained earnings of the parent at the beginning of the year using the cost model. Then we have to deduct the downstream net unrealized gain on sale of equipment prior to 20x5 is 12,500 minus 1875. So we have now the unrealized gain, which is to be deducted from the retained earnings beginning. Then we have the adjusted retained earnings of the parent using the cost model. And we add now, we have the retained earnings that have been realized in transactions with third parties because we have already deducted the net unrealized gain on sale of equipment between the parent and the subsidiary. Then we have now the adjustments to convert from cost model to equity method for purposes of consolidation or to establish reciprocity, parent share in adjusted net increase in subsidiaries retained earnings. We have now the retained earnings of the subsidiary beginning, and we deduct the January 1, 20x4 balance. So that's after 1 year, we have the amount of increase in retained earnings since the date of acquisition. Then we have the amortization of allocated excess in 20x4 for 11,000, and we have the net unrealized gain on sale of equipment prior to 20x5. Now we have the amount of 26,000 minus 3250 or 22,750 or a difference of 12,250. And we multiply it by the non-controlling interest or by the controlling interest. That is 80%. So we get now the amount of 9,800 and deduct the goodwill impairment loss given at 2,500. So we have 7,300 as adjustment. To convert the cost model to equity method, we are now adding 7,300 and the consolidated retained earnings on January 1, 20x5 of 413,175. And we add the controlling interest in consolidated net income or profit attributable to equity holders of parent for 20x5. So we have now the total of 633,475, and we deduct dividends paid for 20x5 of 60,000. So the difference of consolidated retained earnings by December 31, 20x5. Now that's how we have the alternative computation of 573,475 by adding now the retained earnings of the parent at the end of 20x5. Then we add 8,125 for the net unrealized gain on sale of equipment. We have the adjusted retained earnings by December 31, 20x5 with the use of the cost model. Sun Company's retained earnings that have been realized in transactions with third parties. And we now get adjustments to convert the cost model to equity method for purposes of consolidation or to establish reciprocity. Parent share na adjusted net increase in subsidiaries' retained earnings. So we have now the retained earnings of the subsidiary. We have the ending and the beginning balance. That's as of the date of acquisition. We have the increase since date of acquisition. Then we deduct accumulated amortization of allocated excess in the amount of 17,000, and we have now the upstream unrealized gain on sale of equipment. That's upstream because we have now the upstream, the seller is the subsidiary. And we have the multiplication by the controlling interest percentage. Then we have the goodwill impairment loss, the consolidated retained earnings on December 31, 20x 5. Okay, so we have now 573, 475. Then we have now the computation of the non-controlling interest using the partial goodwill approach on December 31, 20x5. We have now the common stock of the subsidiary at the end of 20x5. Then you have the retained earnings computed as retained earnings beginning. Then we add net income of the subsidiary, deduct dividends. We have the stockholders' equity of the subsidiary company by December 31, 20x5. Then we have the adjustments to reflect fair value over or undervaluation of assets and liabilities date of acquisition, which is January 1, 20x4. And the amortization of allocated excess. We have to refer to amortization above in the amount of 11,000 in 20x4 and 6,000 in 20x5. So we have now total of 17,000, the amortization of allocated excess. So the difference is the fair value of stockholders' equity of subsidiary on December 31, 20x5, and deduct the upstream net unrealized gain on sale of equipment prior to December 31, 20x5, which is 26,000, but we have already 3,250 realized for 2 years. So we have now the difference of 19,500. So the realized stockholders' equity of subsidiary on December 31, 20x5, and we multiply it by 20%, the controlling, non-controlling interest under the partial goodwill approach. Or we have the alternative computation, the non-controlling interest under the partial goodwill approach on January 1, 20x5. Then we have the non-controlling interest in net income in 20x5. And we have now the dividends, 40,000 multiplied by 20%. So we have the non-controlling interest under the partial goodwill approach, or we have now the common stock. This is another alternative solution, the common stock of the subsidiary company on January 1. Then we have the retained earnings to be added. Then the total stockholders' equity on January 1 and the adjustments to reflect fair value over or undervaluation of assets and liabilities as of the date of acquisition. Then we have the amortization of allocated excess in 20x4. And we have the fair value of stockholders' equity of subsidiary on January 1, 20x5. Realized gain on sale of equipment for the upstream sales through depreciation. And we have the realized stockholders' equity of subsidiary on January 1, 2005, and we multiply this by the non-controlling interest percentage. Then we have the non-controlling interest, partial goodwill on January 1, 2005, and we add the non-controlling interest in net income and deduct dividends. So it's still equal to the non-controlling interest share of the December 31, 2005 using the partial goodwill approach. Now, for illustration 5-5, 80% owned subsidiary using the cost model, full goodwill approach, downstream and upstream sale of property, unrealized gain and realized gain on sale. So we have now to refer to illustration 5-4 for determination of separate net income, computation of full goodwill, amortization of allocated excess, and impairment of goodwill. The resulting ownership situations can be viewed in the schedule of determination and allocation of excess. So we have now the schedule of determination and allocation of excess when the date of acquisition as January 1, 20x4. So we now begin with the fair value of subsidiary, 80%. Then we have the consideration transferred or 80%. We are now adding 77,500 fair value of non-controlling interest given at 20%. And we have the fair value of the subsidiary at 100%. Now we are adding. Deduct the book value of stockholders' equity of SAN, a common stock of 200,000 multiplied by 100% and retained earnings of 100,000 times 100%. So the total of 300,000. Other difference of 500, that's the allocated excess. Excess of cost over book value, and deduct the over or undervaluation of assets and liabilities. So we have now the increase in inventory, considering an undervaluation. So we multiply 5,000 times 100%. And we have now the increase in land, increase in equipment, decrease in buildings to be deducted, and decrease in bonds payable. Now there's a decrease, and bonds payable is a liability. So decrease in liability would mean a positive effect. So we have now the positive excess using full goodwill excess of cost over the fair value for 12,500. And we have the summary of depreciation and amortization adjustments. We have this account adjustments to be amortized. So inventory 5,000. That's good only for the current year. 20x 4. And we have now the after inventory, we have subject to annual amortization equipment at net, and we have buildings at net and bonds payable. So we have now the estimated life of the asset, like equipment, it's for 8 years. So we have the annual amortization of the undervaluation or overvaluation this time for buildings. So we have the annual amount of 10,000. So for the current year, 24, it's 10,000. Another 10,000 for 20x5. For buildings, we have now buildings of 20,000, and the annual amortization is 5,000, and this is for life of 4 years. Then the bonds payable, the discount is equivalent to 1,000. That's 4,000 divided by 4. So 1,000 a year, and we have to reflect it in our amortization adjustments. So we have now for the journal entries. Here we have the journal entries. First year of after acquisition, the parent company cost model entry. When the cost model is used, only 2 journal entries are recorded by the parent, no, which is Perfect Company during 2024 related to its investment in Sun Company. So entry 1 records Perfect Company's purchase of Sun Company stock, and entry 2 recognizes a dividend income based on the 24,000, that's 30,000 times 80% of dividends received during the period. So the first entry of the parent is to debit the investment in Sun, 310,000, and credit to cash. Second entry is to record the dividends received, cash dividend. So the entries to debit cash and to credit dividend income. Now that's dividend income for the 80% share of the parent. So on the books of the Sun Company, the 30,000 dividend paid was recorded as follows. That's not in the books of the Sun. The dividends paid or declared account is temporary account that's close to retained earnings at year end. An alternative to debit retained earnings directly when dividends are paid or declared, but you may still debit to dividends. And finally, debit to retained earnings and credit to dividends. No entries are made on the parents' books to depreciate, amortize, or write off the portion of the allocated excess that expires during 20x4. For the consolidation work paper, first year of acquisition, the schedule of determination and allocation of excess presented above provides complete guidance for the worksheet, eliminating entries on January 1, 20x4. So we have now the elimination entries for debit to common stock of Sun, debit to retained earnings, and we credit to the investment in Sun, and we have another credit which is now dividends. So the entry for common stock is to eliminate the account of the subsidiary common stock and retained earnings. And we have now the credit to investment for 240,000 and credit to non-controlling interest of 300,000 times 20%. So to eliminate intercompany investment in equity accounts of subsidiary on date of acquisition and to establish non-controlling interest in net assets of subsidiary on date of acquisition. We have now the second entry, debit to inventory, and then debit to accumulated depreciation for the equipment and for the buildings, debit to land, discount on bonds payable, and also another debit is discount on bonds payable for 4,000 and debit the amount of here. We have to a debit discount on bonds payable 4,000 and another debit is for accumulated depreciation of equipment and buildings, then debit to land for the under valuation, debit to discount on bonds payable, and we also debit to accumulated depreciation of the equipment and the buildings, debit to land, discount on bonds payable, and debit to goodwill for 12,500. Then we credit to buildings, credit to non-controlling interest at 20% of 76 as 75,000 times 20%. So we now get 12,500 full minus 10,000 partial goodwill. So we now get the amount net of 17,500, and to credit investment in Sun Company to complete the debit of 170,000. So next, we have the since the setup entry in E2 and CI at fair value, non-controlling interests have a share of entity goodwill and hence are exposed to impairment loss on goodwill. PS 36 require the impairment loss to be prorated between the parent and the non-controlling interest. And at the same time, we have the impairment loss is not prorated in accordance with the proportion of goodwill recognized by parent and NCI. We have to debit the amount of here depreciation. That's for the periodic amortization, debit depreciation, debit accumulated depreciation for buildings, debit to interest expense, goodwill impairment loss, and credit to inventory, accumulated depreciation of equipment, debit to discount on bonds payable, and credit back to goodwill. The explanation is to provide 24 impairment loss and depreciation and amortization on differences between acquisition date fair value and book value of SAN's identifiable assets and liabilities. So we now have the inventory sold. It's already part of cost of goods sold. Then we have the equipment to be added is 10,000, and the buildings for negative 5,000, and we now debit to okay. So we have now your adjusting entry for debiting cost of goods sold, and then depreciation or amortization expenses. One is added, the other one is deducted, depending as to whether it's an under or over valuation. Then we have the bonds payable, annual amortization of discount. So for dividend income debit, 24,000. We now debit non-controlling interest of 6,000. That's 20%. And the credit to dividends paid of 30,000. To eliminate intercompany dividends and non-controlling interest share of dividends. Now for the here the adjusting entry, and as well as your elimination entry for the purpose of recording dividend income, debit to dividend income of perfect and non controlling interest of 30,000. So to eliminate intercompany dividends and controlling interest. Okay, so we now debit to, finally, debit dividend income, a perfect or the parent, debit to non-controlling interest for 6,000, and credit dividends paid by subsidiary in the amount of here. Debit to discount on bonds payable 1,000 per year, and debit to goodwill. So the last entry here, so debit dividend income, debit to non-controlling interest at 30%, or 30,000 times 20%, and to credit dividends paid of 30,000. We have now the entry to close gain on sale of equipment. We have to close intercompany reciprocal accounts. So debit, equipment, and credit accumulated depreciation of equipment. To eliminate the downstream intercompany gain, and at the same time restore to its original cost to the consolidated entity, along with accumulated depreciation of the point of the intercompany sale. So next entry number 6, we close gain on sale of equipment, debit to equipment, and credit accumulated depreciation. Then we now debit accumulated depreciation, credit depreciation. This now to adjust downstream depreciation on equipment sold to subsidiary, thus realizing a portion of the gain through depreciation. So we have 12,500 divided by 5 years, and we multiply this by 12. So that's how we got 1,875. Also debit to accumulated depreciation on equipment, credit to a depreciation expense for 3,250 to adjust upstream depreciation expense on equipment sold to parent, thus realizing a portion of the gain through depreciation. Okay. So we now get the debit for E8, debit 2, accumulated depreciation, that's equipment 3 to 50, debit 2, depreciation expense, and we credit 3 to 50 to adjust upstream depreciation, thus realizing a portion of the gain through depreciation. So we have now the computations for the non-controlling interest net income of subsidiary. We now have the computations net income of subsidiary. Then we have to deduct the unrealized gain on sale of equipment. We add the realized gain. Now considering that we have an upstream sale, then the difference of 53,250, we have now the realized net income from separate operations. So we now get the realized profit to the extent that it's added by the parent to the extent that the realized profit this time is in the books of the parent kung downstream, pero kung upstream, then it's in the books of the subsidiary. So we have now the non-controlling interest in net income of 7,825. Now we have the consolidation worksheet for consolidated financial statements at the end of 2024. The cost model of full goodwill, 80% on subsidiaries of the first year of acquisition. So we have now the 5-column worksheet with the first column, the parent, second column, subsidiary, then we have the debit and the credit sides for adjustments, and finally, the consolidated balances. So for the parent, initially is 400,000. However, we have an adjustment, no? Second column is sun. So we have now the adjustment all for the parent and the subsidiary, and finally leaving the consolidated balances. So for sales, then parent and subsidiary total 600,000. Gain on sale of equipment in the books of the parent, 12,500. In the books of the subsidiary sa upstream sales, 26,000. So we have now your adjusting entries, which are numbered letter C, no? Or we have your gain on sale of equipment for 12,500 and 26,000, and then we have the debit of 26,000 in entry number 6. So you can find it in second column for the credit. But anyway, we have the elimination of the gain on sale of equipment the balance of this is 0. The dividend income of the parent, then subsidiary for adjustments. Anyway, we have the debits and credits for our dividend income, and eliminated for the credit minus the debit, eliminated because it is an intercompany dividend. So we have now the amount of the total revenue. Then we have cost of goods sold, depreciation expense after recognizing whatever adjustments. We have interest expense. We have here a debit for discount on bonds payable. The discount is I think it's 5,000 no a year for our depreciation expense, and we have the interest expense 1,000 a year. That's on discount on bonds payable. Then we have other expenses. We have the goodwill impairment loss for after this. Again, we have to extend to the consolidated column before the preparation of the consolidated statements. So we have the elimination entries. Actually, they are properly numbered. And after the elimination entry, like for example, you have your depreciation of perfect 50,000, then we have 20,000. That's supposed to be a debit. Then after that, we have the balances like depreciation expense, 50,000 debit, that of we have the amount of initial 50,000, that of parent, subsidiary 20,000. So the total of 70,000. In 70,000, we have an adjustment for debit by 5,000 and credit for 1,875 and 3,250. So we are leaving the amount of 69,475. Then we have the accounts to be adjusted in the elimination worksheet, including the common stock and the retained earnings of the subsidiary, dividends paid, and we have the retained earnings beginning, and we consider the balance sheet accounts, including cash and the inventory, land, and equipment. Now, these are the same amounts that we keep on repeating above. So we have now discount on bonds payable 4,000. First adjustment is 1,000. That's on year one, because the life of the bonds is still 4 years. So ang 4,000 nga discount on bonds payable, divide it by 4 years. That's why we have 1,000 a year for the amortization of discount. Then we have finally at the end, we have to eliminate the common stock accounts, leaving only that of subsidiary, the parent. The subsidiaries common stock will be eliminated. So we have now the consolidated net income, retained earnings, and controlling interest, which can be verified in figure 5-7, can also be computed as follows. We have now the consolidated net income for 20x4, parent company's net income from separate operations, and then we have to deduct the unrealized gain on sale of equipment, and we have to add 1,875. So the total, that's the parent company's realized net income from its own separate operations. Then we add that of the subsidiary. So take note that whatever reciprocal accounts should be eliminated. So we have now the consolidated. Okay, so we have now the next slide. On the date of acquisition, the retained earnings of parent should always be considered as the consolidated earnings. Actually, we have to call it consolidated, but that of the parent, we are trying to adjust, no? And finally, eliminate. Now, on date of acquisition, the retained earnings of parent should always be considered as the consolidated retained earnings. So we have the amount of 300,000. Subsequent to date of acquisition, consolidated retained earnings will be computed as we have the consolidated retained earnings. So we have now the consolidated retained earnings on December 31, 20x4, retained earnings of parent. We add the controlling interest in consolidated net income. From the total, we deduct dividends paid, parent companies. We have so we have now the consolidated retained earnings. We begin with the balance, so the date of acquisition. Then we add the controlling interest in consolidated net income or profit attributable to equity holders of parent. Then from the total, we deduct dividends paid, parent company for 20x4, then consolidated retained earnings to be carried over to the worksheet. On the date of, okay, assume the following information available for perfect and sun for year 20x5. So we have sales for the two companies. So we have now sales of the parent and the subsidiary. So we have sales, and then we deduct cost of goods sold, gross profit, deduct depreciation expense, and other expense. So we have net income from its separate. So we have now the net income of the So we have now dividends paid by parent 60,000, subsidiary only 40. So we have the year of disposal of property and equipment by purchasing affiliate using the cost model. Assume that in January 1, 2024, the company sells the equipment it purchased from S company to a third party affiliated group for 200,000. The recorded amount here and consolidated book values of the equipment. Okay, so we have now the cost to P company or the parent of 300,000. We have to deduct the accumulated depreciation of so the amount of cost, then also so we have now the books of the parent cost to P company 300,000. Then we deduct amortization, accumulated depreciation for 2 years of 120,000. So the recorded book value in January 1, 20x4 is 180,000. Then we have now the cost, original cost to is company. Then we have the accumulated depreciation for 120,000, the recorded book value in January 1, 2024 of the parent. And the consolidated, the original cost to S company and the accumulated depreciation, 800,000 minus 150,000 times 2. So we have now the cost model and equity model. Oh, so we have now the amount of 400,000 in consolidated minus for how much? Okay. So we have now P company will record a 20,000 gain on the sale of the equipment to the party outside the affiliated group, calculated as, so for the selling price minus the book value of 180,000, the gain on sale of 20,000. So for the books of the parent, debit to cash, debit to accumulated depreciation, credit to equipment, and credit to gain on sale of equipment. So we have now the amounts of 200,000. That's the sales of the parent to the subsidiary. So we now have debit to cash, debit to accumulated depreciation, credit to equipment, and credit to gain in sale of equipment for 20,000. Then we have now the consolidated book value of the equipment on the date of the sale by P company. It's only 150,000. That's the consolidated book value. And from the point of view of the consolidated entity, a 50,000 gain on the sale as selling price of 200,000 and book value 150 should be recognized with the entry debit to retained earnings, perfect company, 30,000 times 85%. Then we debit to non-controlling interest on January 1, 2024 for the amount of 4,500. Then credit to okay, so we have now non-controlling interest 30,000 times 15% and credit to gain on sale of. Okay, so we now involve the elimination entries. So debit to retained earnings and okay, so we have now the retained earnings of the parent. January 1, 2024 is 30,000 multiplied by 85% and debit to non-controlling interest at 4,000 at 30,000. So we have now the credit is oh, so we have now to credit financial. So we have the above entry serves to adjust controlling interest. Okay, so we have now the credit to 30,000 as this was so we now get debit to retained earnings for parent, then non-controlling interest and credit gain in sale of equipment. Now, after December 31, 2024, no more book value or paper entries relating to this equipment will be required because by that date, the amount of gain recorded by the affiliates is equal to the amount of gain considered replied. So for the amount of net income to be recorded by the affiliates for 20x2, 20x3, gain on sale from S company considering that we have a downstream sale and gain on sale for 20x3 in the amount of 20,000. Additional depreciation expense recorded by affiliates in 20x2 and 20x3. Net amount of net income recorded by affiliates, and we have the amount of net income realized in the consolidated income as statement, the selling price to the consolidated entity and the book value of the consolidated entity in January 1, 2024. So we have the net amount of net income to the consolidated entity. So with the use of the equity method, the accounting objective is to report the subsidiaries or the investors, to report the subsidiaries or the investors' investment and investment income reflecting the close relationship between parent and subsidiaries. Now remember that under the cost model, there are only two entries needed in order to recognize the investment of the parent, and one is to record the initial investment taken by debiting investment and crediting to cash, and this second entry is to record the share of the parent in the dividend income paid by the subsidiary. Now, there are no other entries required except the two. Now that is under the cost model. Now under the equity method, consolidated financial statements amounts are the same regardless of whether a parent company uses the cost model or fair value model or equity method to account for the subsidiaries results of operations. However, the working paper eliminations used in both methods are different as illustrated in this chapter and on the succeeding chapters. Now, we are referring to the elimination entries. The amounts in the consolidated financial statements are amounts appearing in the books of parent company under the equity method, which ensure particularly the following aspects. One, the parent company's net income is reported is exactly equal to the controlling interest in consolidated net income on the consolidated financial statements, and the parent company's retained earnings is exactly equal to the consolidated retained earnings on the consolidated financial statements, and the parent company's common stock is exactly equal to the consolidated common stock on the consolidated financial statements. The parent company's additional paid-in capital is exactly equal to the consolidated additional paid-in capital on the consolidated financial statements, and the parent company's dividends declared or paid is exactly equal to the consolidated dividends declared or paid on the consolidated financial statements. Now the amounts in the consolidated financial statements are amounts appearing in the books of parent under the equity method, which ensure particularly the following aspects. So these are very, very important guide in connection with the use of the equity method. So we have the summary of work paper elimination entries for the intercompany profit using the equity method, intercompany gain on sale of equipment. So we have this selling affiliate is the parent for the downstream sales, and this selling affiliate is the subsidiary or the upstream sales. So the entries in the year of intercompany sale, we now debit to gain on sale, debit to equipment, and the credit to accumulated depreciation if the selling affiliate is the parent. If the subsidiary, still we have the same entry, but the explanation is to eliminate unrealized gain on intercompany sale in the year of sale and to restore equipment to its original cost and accumulated depreciation or book value to its balance at the date of the intercompany sale. Now, to the extent that we have an upstream or a downstream sale. So we now debit to accumulated depreciation and credit to depreciation expense to reverse the amount, if any, of excess depreciation recorded during the current year, thus recognizing an equivalent amount of intercompany profit as realized. So the entries in years subsequent to year of intercompany sale. So we now debit to investment in subsidiary, debit to equipment, and credit to accumulated depreciation. And here we have under the equity method still, if the selling affiliate is subsidiary, we now debit to investment in subsidiary, we debit to non-controlling interest and credit to equipment, credit to accumulated depreciation. And the explanation is to reduce the controlling and non-controlling interest for the respective shares of the intercompany gain, to restore accumulated depreciation and equipment to their original balances at the date of inter company sale. So we have now the second entry, debiting to accumulated depreciation, crediting depreciation expense, and credit to investment in subsidiary. Now you have the debit to accumulated depreciation, credit to depreciation expense, credit to investment in subsidiary, and credit to non-controlling interest. For if we have the selling affiliate, this time is the subsidiary or involving an upstream sale. Then we have illustration 5.6, 80% on subsidiary under the equity method, partial goodwill with goodwill impairment loss recognized in the books of subsidiary. Assume that on January 1, 2024, Perfect Company acquires 80% of the common stock of Sun Company for 310,000. At that time, the fair value of the 20% non-controlling interest is estimated to be 77,500. On that, the following assets and liabilities of Sun Company had book values that were different from their respective market values or fair values. So this time, we have the book values and the fair values of the inventories, the land, the equipment, accumulated depreciation of the equipment, and the buildings, accumulated depreciation of the buildings, and the months payable. We are now given the fair values in this second column. In other words, the inventory is undervalued. The same with land, and the equipment is actually the fair value is higher than the book value. The buildings with the accumulated depreciation of 140,000, but the fair value is only 120,000, and the bonds payable with book value of 96,000, but the fair value is only, the book value is 100,000, the fair value is only 96,000. In other words, the book value is higher than the fair value, which will involve a discount. So we have now the all other assets and liabilities had book values approximately equal to their respective fair values. In January 1, 2024, the equipment and buildings had remaining life of 8 and 4 years. Respectively, inventory is sold in 2024 and FIFO inventory costing method is used. A goodwill, if any, is reduced by a 3,125 impairment loss during 2024 based on the fair value. So this time, based on okay. So we have here we are trying to illustrate the use of the equity method. So again, comparing the book values with the fair values, this time recognizing either undervaluation or overvaluation. So we have now the trial balances of the parent and the subsidiary with the debits and the credits this time as they are given as of the beginning of the year. From the trial balances presented above, the following summary for 2024 results of operations are as follows. So we have now the amount of sales minus cost of goods sold, and we have the gross profit and the deduct depreciation expense and other expenses. So we now have the net income. We add gain on sale of equipment and net income from its own separate operations. Then add investment income, giving the final net income for the parent and the subsidiary. Then we have now the schedule of determination and allocation of excess using partial goodwill as of the date of acquisition. So we have now the fair value of the subsidiary for the consideration transferred by the parent of 310,000. And we have now the book value of stockholders' equity of subsidiary at 80%. So the common stock 160,000 and the retained earnings of 80,000 for the total of 240,000. Deduct this from 310,000. The allocated excess of cost over book value of 70,000. Then we deduct over or undervaluation of assets and liabilities. We have increase in inventory, in land, in equipment, but decrease in building and bonds payable. Take note that the effect of decrease in bonds payable is an addition, considering that this is a liability. So we have now the positive excess, partial goodwill excess of cost over fair value. Then the undervaluation of assets and liabilities are summarized below. When we have now your inventory, the book value is 20,000, the fair value is 25,000. So in other words, there is an undervaluation by 5,000. Then the same with land, undervaluation man and equipment, but buildings, bonds payable, overvaluation. So the buildings and equipment will be further analyzed for consolidation purposes as follows. So we have now the equipment minus the accumulated depreciation. The difference is net book value, and then for the buildings minus accumulated depreciation, we have the net book value. So it's summary of or depreciation and amortization adjustments are given. So we have now the amount, annual amount in the current year. So we have now the goodwill impairment loss of 3,125 based on 100% fair value to be allocated to the controlling interest and non-controlling interest based on the percentage of total goodwill each equity interest received. So for purposes of allocating the goodwill impairment loss, the full goodwill is computed as follows. So we have now the fair value of subsidiary, a consideration transferred at 80%, fair value of the NCI given 20%. So the fair value of the subsidiary is 387,500. We deduct the book value of the stockholders' equity of Sun with common stock 100%. So difference is allocated excess of cost over book value, and we have the undervaluation of assets and liabilities for 75,000. So the excess, which is positive under the full goodwill approach, excess of cost over the fair value, 12,500. Now, if you will notice that the amounts that we are using here are still similar to the amounts that we have been using in the previous slides. So we have now the goodwill applicable to a parent and to NCI, the total of 12,500. And the goodwill impairment loss attributable to parent or controlling interest, we have now 2,500 or 80%, and goodwill applicable to NCI or 625, a total of 3,125. That's for the goodwill impairment loss based on 100% fair value or full goodwill. So we have now the unrealized gain on intercompany sale for 20x4, April 1, 20x4, and January 2, 20x4 for the selling price, the book value, the unrealized gain on sale, and the remaining life. So we have the realized gain in 20x4, we have 1,875 and 3,250. So we have now the entries as of the first year of acquisition. The following are the entries recorded by the parent in 20x4 in relation to its investment. Now, this is under the equity method. So, the parent on January 1, 20x4 debits to investment in Sun, credit to cash. So, we have now the acquisition of the subsidiary. The entries from January 1, 2024 to December 31, 2024, we now debit to cash, credit to investment in Sun, that is to record the share of the parent in the dividend given by Sun. Now, the dividend given was 30,000. Only 80% belongs to the parent. Now, if we recall, under the cost model, the entry is merely to debit cash and to credit dividend income. As there are only two important entries in connection with the cost model. In connection with the cost model. Okay, so going back to the equity method, we have to take note of the investment entry, and then for the receipt of the annual dividends, take note that we are crediting the investment account. So, bali, nag-reduce ang investment account balance for the dividends received from Sun. And then for the net income, the share of the parent in the net income of the subsidiary, with debit to investment. So, bali, nag-increase ang investment. Debit to investment in Sun and credit to investment income. So, bali, ang ga-debit ka investment kung mag-invest. Ga-debit ka pagid kung may share ang parent sa net income sang subsidiary. So, ga-debit ka investment. Ma-credit ka investment kung may dividends. Kag ma-credit ka investment kung may loss ang subsidiary, no? So, baliskad sang income. So, ma-debit ka kung may loss, ma-debit ka loss from investment and you credit to investment account. Now, on December 31, 2024, nag-debit siya investment income and credit to investment in Sun for the amortization of the allocated excess of inventory, equipment, buildings, and bonds payable and goodwill impairment loss. So, nag-decrease ang investment kag nag-decrease man ang income. On December 31, 2024, another entry is to debit investment income and to credit investment. So to adjust investment income for downstream sales for the unrealized gain on sale of equipment. Ina kon unrealized. Take note again that we are crediting investment account kung unrealized. Now, kung unrealized, amo na debit mo investment income and to credit investment in subsidiary kung may unrealized. Okay? So, kung realized, ma-debit ka debit investment account and to credit investment income. So, bali, kung unrealized, ka-debit ka investment income, kag mag-credit ka investment account. Kung may realized, then ma-debit ka investment. Kung may realized, debit ka investment account and to credit investment income. Okay, so these are the very important entries in connection with the use of the equity method. The investment balance and investment income in the books of the parent companies. So we have now for the investment account. So we have now the cost of 310,000. So we have now investment, debit, net income of subsidiary, debit mo gyapon ni investment, and for realized gain, you debit investment, and for the realized downstream and upstream sale, then you are going to credit the account for the dividends, for the amortization and the impairment loss, credit mong investment, and you credit unrealized gain in downstream sale and unrealized gain on upstream sale. Now, in the event that there is a loss, you also debit to in a loss from investment and to credit investment Now, at the bottom, we have the debits and credits to investment income for amortization and impairment, then unrealized gain downstream and unrealized gain upstream. We debit this to investment income and credit for the net income of subsidiary and for the realized gain on downstream and as well as upstream sale. So we have now the consolidation work paper for the first year of acquisition, the schedule of determination and allocation of excess presented above provides complete guidance for the worksheet eliminating entries on January 1, 20x4. So we now close the common stock account and retained earnings, and we also credit to investment in Sun and credit to non-controlling interest. So for this, we have the elimination of the investment on January 1, 2024 and the equity accounts of subsidiary on date of acquisition and to establish non-controlling interest in net assets of subsidiary. So again, we close common stock, we close retained earnings, we credit investment account and credit to the non-controlling interest for the proportionate share. And the second entry will be to record inventory because of the undervaluation, then accumulated depreciation of the equipment, and we have now the amount of 80,000 debit to accumulated depreciation of buildings, debit to land, debit to discount on bonds payable, and we have to credit here. We have an amount to be used for a goodwill. Okay, debit to goodwill, credit to buildings, and non-controlling interest and investment account for 70,000. So the first entry, E1, 240,000 is credit to investment account, and then we are adding 70,000. So that makes a total of 310,000, the total amount of the investment which we now close. So we debit to cost of goods sold, depreciation, accumulated depreciation of building, interest expense, a goodwill impairment loss, credit to inventory, accumulated depreciation of equipment, and credit to discount on bonds payable, and credit to goodwill to provide for 20x for impairment loss and depreciation and amortization on differences between acquisition date fair value and book value of Sun's identifiable assets and liabilities as follows. So we have now the net income of Sun and the realized gain, and now we have the debits and the credits to the investment account, and we have the debits and credits to the investment income account. Now take note of this for your guide. After the eliminating entries are posted, investment account, it should be observed that from consolidation point of view, investment accounts is totally eliminated. So the investment in Sun, we have the debit of 310,000. Then for the net income share, we debit to investment 6,800, and for the realized downstream sale and upstream sale. So the balance on December 31 X4, 306 1,675. Then we have to credit investment for dividends, for amortization and impairment, for the unrealized downstream and upstream sale, and the credit investment January 1 at 20x4, and this same with 70,000. So we have now the total of the debits and credits for 310,000. In second year, number 5 and 3, debit to gain on sale of equipment to close, debit to equipment, and credit to accumulated depreciation of equipment for 37,500. Here we have let number 6, gain on sale of equipment, debit to equipment, credit to accumulated depreciation, and here for E6, debit to gain on sale and debit to equipment, credit to accumulated depreciation to eliminate the upstream intercompany gain and restore to its original cost to the consolidated entity along with accumulated depreciation at the point of the investment sale. Then debit accumulated depreciation and credit to depreciation expense. Now we have the non-controlling interest in net income of subsidiary. So we have now non-controlling interest in net income of subsidiary and non-controlling interest for 8,450 net income of subsidiary. Then we deduct the unrealized gain on upstream and the realized gain on upstream. Then we have now the realized net income from separate operations. Then we have the amortization of allocated excess. 20% is the share of the non-controlling interest. And we have the elimination entries, work paper. At this time, take note of the debits and credits, especially on the investment account. We have the investment account here, which should be eliminated. Investment in Sun initially for 306,675, and we have a debit of 3,300,000. Okay, so we have now the elimination entries. Take note of the corresponding pairs of the accounts. So we have now for the consolidated net income for 20x4, and finally for the non-controlling interest in net income. Since non-controlling interest share of goodwill is not recognized, no adjustment is required for the impairment loss on goodwill, and impairment losses are not shared with non-controlling interest. Okay, so we have now the on the date of acquisition, the retained earnings of parents should always be considered as the consolidated retained earnings. Thus, consolidated retained earnings on January 1, 2024. We have now the retained earnings of parent, and on subsequent to the date of acquisition, consolidated retained earnings will be computed as follows. So we have now the consolidated retained earnings. Take note that we have the share of the parent. We are also deducting the dividends paid. Now we have four. The goodwill recognized on consolidation purely relates to the parent share. A non-controlling interest is measured as a proportion of identifiable assets, and goodwill attributable to NCI share is not recognized. The NCI on January 1, 2024 and December 31, 2024 are computed as follows. So we have now the non-controlling interest using the partial goodwill approach on December 31, 2024 477,450. Alternatively, NCI on December 31, 2024 may also be computed as follows. So we have the NCI using partial goodwill on January 1, 2024, then the NCI 20x4, and the dividends for 6,000. So that's the non-controlling interest using partial goodwill. Now, for the second year of acquisition, we assume the following information available for Perfect and Sun for the year 20x5. So we have now Perfect Company, Sun Company for the amount of net income, and as well as for the dividends paid. So we have now the parent company equity method. The following are entries recorded by the parent in 20x5 in relation to its subsidiary investment. So on January 1 up to December 31, 20x5, we debit to cash and credit to investment in Sun, 40,000 times 80%, then record dividends from Sun Company. And on December 31, 2025, we debit to investment in Sun and credit to investment income. Record share in net income of subsidiary. So on December 31, 2025, we have to debit investment income and credit to investment in Sun for the allocated excess of inventory, equipment, buildings, and bonds payable. On December 31, 2025, we debit to investment account and credit investment income for a downstream sales. Basta nga realized gain on sale of equipment or whatever tangible fixed assets kung realized kani with debit investment and credit investment income for realized gain. So we have the usual increase. Then we have now the balances of the investment in Sun account and investment income. So for here we have the elimination entries. We debit to common stock. In the books of the Sun, we debit to retained earnings. For the retained earnings of Sun, credit to investment in Sun, credit to non-controlling interest, and to eliminate investment in January 1, 20x5 and equity accounts of subsidiary on date of acquisition and to establish non-controlling interest in net assets of subsidiary in January 1, 20x5. So we now debit to accumulated depreciation for equipment and for buildings. Then a debit to land, debit to discount, and debit to goodwill. We credit to buildings, non-controlling interest, and investment in Sun. So next entry will be to debit depreciation, accumulated depreciation, then interest expense, credit to accumulated depreciation, and credit to discount on bonds payable. So these are your depreciation, amortization, expense at for the equipment, the buildings, net of 5,000, and for bonds payable 1,000. So you have total of 6,000. Debit to investment income, debit to non-controlling interest, credit to dividends paid, and investment in Sun to eliminate intercompany dividends and investment income under equity method and establish share of dividends computed as follows. So we have now investment in Sun. Okay, we have the debits and the credits, and as well as investment income account. So as well as the entries to eliminate downstream intercompany gain. So we now have and restore to its original cost to the consolidated entity along with its accumulated depreciation at the point of the intercompany sale. So we now debit to investment in Sun and debit for the non-controlling interest and equipment, credit to accumulated depreciation. Now these are the entries in connection with the recognition of the undervaluation and overvaluation. So net income of subsidiary, and then we have the realized gain on sale of equipment for the upstream sale through a depreciation, and we have now the share of Sun and realized net income, and the 6,000 negative amortization of allocated, it says. So we have now the non-controlling interest in net income as computed. We have now the elimination entries in the worksheet. We post the elimination entries. And so the consolidated net income, consolidated retained earnings, and non-controlling interest at the end of 20x5 is the same with the illustration 5.4, except only in the computation of consolidated retained earnings. So we already have this in 5-4. With the consolidated retained earnings of 573,000 475, non-controlling interest using the partial goodwill approach of 83,900 with the alternative computations. So now the non-controlling interest on December 31, 20x5 of 83,900. We have the common stock subsidiary, then retained earnings added, and we have the adjustments to reflect a fair value. We have to deduct the amortization of allocated excess. So the total of 384,000. Then we have the addition of the realized gain on the upstream sale. And we have now the realized stockholders equity. We multiply this by 20%. So 77,450. The non-controlling partial goodwill in January 1, 20x5. So we add the non-controlling interest in net income in 20x5. And we have the amount of 14,450. Then we have to deduct dividends of 8,000, giving the non-controlling interest on December 31, 20x5 of 83,900. Now here we have illustration, 80% owned subsidiary under the equity method, full goodwill with the goodwill impairment loss recognized in the books of subsidiary. So assume that on January 1, 2024, Perfect Company acquires 80% of the common stock of Sun for 310,000. At that time, the fair value of the 20% non-controlling interest is 77,500. On that, the following assets and liabilities had book values that were different from their respective market values. So we have the inventory. We have one with high appraisal. Then we have equipment and accumulated depreciation. We have now the treatment of the account still similar to the previous. So take note that we have here the trial balances of the two companies, and with the results of operations still have the same amounts of net income, the allocation of excess. So we have now a positive excess under the partial goodwill approach of 10,000. Then we have the book value and the fair value of the assets of Sun. So we involve under valuation and over valuation. So we have now the equipment account shown in the books. We have the equipment account in the books. And finally, bonds payable is to be amortized over 4 years. So the goodwill impairment loss of 3,125 based on 100% fair value would be allocated to the controlling interest and NCI based on the percentage of total goodwill each equity interest received. So we have the answers. For purposes of allocating the goodwill impairment loss, the full goodwill is computed as follows. So we have now the full goodwill excess of cost over fair value of 12,500. The consideration transferred cash 80%, 310,000. The fair value of subsidiary, no? So we have the NCI 77,500. Fair value of subsidiary is 387,500. Then we deduct the book value of stockholders' equity. We have now it's 500. This is the allocated excess of cost over book value. However, we have the amount of 75,000 is the undervaluation of assets and liabilities at 75% of 100 or 75,000 times 100%. So the positive excess of 12,500. Here, 10,000 belongs to parent and to NCI 2,500. And we have now the goodwill impairment loss applicable to parent or controlling interest. So we have 2, 5, and 625. Now, here we are giving, we have the unrealized gain on sales. Okay, so we have now the impairment loss. And here again, we have the journal entries. Under the equity method, take note that we debit investment, credit to cash. Then for dividends, debit to cash, credit investment. For the share in net income, debit investment, credit investment income. For share net loss, we debit to loss from investment and credit investment in Sun. And we have now for the amortization of the investment. And here, next, we have the entries. Now you will notice that they are similar to the previous slides. So we have now the schedule of determination and allocation of excess presented above. Provide complete guidance for the worksheet eliminating entries. So here we debit to, meaning we have the elimination entries similar to the previous entries. So debit to investment income, credit to investment, debit to non-controlling interest, and we credit to dividends paid. Now we have the balances, the entries to the investment account and to investment income. For after eliminating entries are posted in the investment income, it should be observed that from the controlling interest point of view, the investment accounts totally eliminated. All right, so after the eliminating entries are posted in the investment account, it should be observed that from consolidation point of view, investment account is totally eliminated. So to the investment account, we have these debits and credits. Take note that the investment account is eliminated. Debit 310,000. This same with credit. And we have the closing entries and the working papers. So the working papers for consolidate here we have the retained earnings of parent should always be considered as the consolidated retained earnings. So we have now the consolidated retained earnings with retained earnings of the parent, and we are now adding the controlling interest of the parent, and after adding that to we deduct dividends paid leaving for 13.1. Okay, so we have now the elimination of the reciprocal accounts, and here we have the summary of determining the non-controlling. Yes. Okay, for the second year, again, we have to leave in 60. Now we are still in the equity method, and take note that these same amounts are involved. Okay, so we have right. So that ends chapter 5. On Monday, we are going to take up problems. I have already given assignment in chapter 5. So that will be on Monday. The exam for the second portion, the prelim, will include chapters 4 and 5. Kaya namin, siguro